Bob Pisani has today's ETF Edge. Hi, Bob.
Scott, good to see you. Investors are in love with their 5% money market and short-term bond funds, but is that a thing of the past? Will investors flee to stocks as yields drop? Let's talk with Matt Bartolini. He's the managing director and head of SPDR Americas Research. Matt, good to see you. Your SPDR short-term Treasury ETFs, I've been following them. They're continuing to get inflows this year, even with the yields dropping. And we have what, $6 trillion in money market funds? No sign of diminishing at all. Can you tell us why investors are so sticky here? Should investors in these funds be pivoting? And if so, what should they be pivoting to?
Yeah, so we have seen consistent inflows into that short end of the curve, but we have started to see a little bit more on a little bit deeper out in the short end, that 1 to 3 year space as well. I think some of the reason why those assets are still flowing in, even though the Federal Reserve has cut rates, is they've only gone 50 basis points. Of course, the forward-looking projection is for another 175 basis points by May. However, you still have some decent yield on that short end. Maybe a little bit further out, you can pick up a little more yield incrementally. But I think as the Fed starts to cut rates significantly into May of 2025, again, probably another 200 basis points from here on out, you'll probably start to see that cash on the sidelines in those money market funds start to rotate out into more risk-seeking type investments. And within fixed income, that would be within credit, preferred stocks, senior loans, high-yield investment-grade corporate bonds, and things like that, where you can still get some sizable yield for those very income-oriented investors.
Yeah, it's amazing. You referenced this. The market's expecting the Fed to cut 150 to 200 basis points in the next year. But we have money market and short-term Treasury yields. They're still in the high 4% range. So are investors thinking it's too early to get out? Why is it so sticky? Or would they still just be happy if yields drop to the low 3% range?
Well, I mean, right now, those rates in the money market funds are just tied to what the Fed funds is right now. They're not going to so much react to the sort of forward-looking projections that the Fed is putting out there. I think what you'll start to see, though, is that, prior to the Fed hiking rates aggressively, money market funds had roughly about $3.5 trillion. And as the Fed started to hike rates, there was a lag effect. There, basically within 3 to 4 months, you started to see assets pile into those money market funds. I think the reverse could be true here. As the Fed starts to cut rates more significantly in the November, December, and then into 2025, you'll start to see a lag effect take place as well. Money market fund assets will start to dwindle. And again, I think that cash on the sidelines will go towards risk-seeking investments, because as those yields decline on money market funds, their returns are declining as well. Yeah. So you're going to have to get that yield from somewhere. And I think into the credit space is one area that investors are starting to look at a little bit right now.
It's amazing to watch the flows this year. Inflows into equity and fixed income ETFs, they're near records this year. We're probably going to have a record year. We have $10 trillion in assets under management. Look at all this money going into equity and fixed income. What's powering these inflows? I mean, this is a really powerful year for flows for ETFs.
Well, I mean, part of it is just the ongoing usage of ETFs in portfolios, that sort of secular case. But near term, tactically, markets are up, equities are up, and that's going to sort of infuse some risk-on sentiment and optimism. But also bonds. Bond markets are up. That hasn't been happening in recent times. We had a lot of negative returns in fixed income. This year, you're finally having positive returns. You're also getting a good coupon because the Fed had hiked rates so significantly heading into this year. So both cross-asset markets, equities, bonds, they're up. Gold is up more than both of those. So in this type of environment, it's, you're seeing capital put to work. And I think there's more capital on the sidelines, particularly in those money market funds.
That's for sure. I need a quick answer to this. Actively managed fixed income is seeing significant investment this year. Actively managed. You've written the fixed income marketplace uniquely lends itself to active management. Why is that? I need a quick answer.
Markets are inefficient. Active management can exploit those inefficiencies for higher income, alpha, and lower volatility. That's pretty simple.
Thanks, Matt. Appreciate it. For more coverage of the ETF universe, check out our website, which contains all the ETF Edge shows, etfedge.cnbc.com.